Let's talk a little bit more about how likely this retreat from extremes is to last. Jim McDonald joins me now. He's Chief Investment Strategist at Northern Trust. Jim, it's good to have you here. So let's start where we just left off with Mike on the inflation situation. You're actually underweight inflation-linked bonds. Why?
They're pretty expensive right now. They've got an expected inflation rate over the next 10 years of nearly 2.6%. And we just think there are better ways to get inflation protection in your portfolio. Natural resources are benefiting from improved growth outlook, and they're also an excellent hedge. So it's just a better way to get some inflation protection, but also benefit from growth in the portfolio. TIPS don't benefit from growth.
But would it be fair to say that you're not expecting 2.6% inflation? Are you saying in some ways you're taking the under, or would you just express it differently? Okay.
Exactly. If you think inflation is going to be above 2.6% over the next 10 years, TIPS make sense. Below that, you really should look for other assets to get your return.
And what you're describing would be more of a Goldilocks scenario for stocks, I would imagine. I mean, if we stay in that kind of 2 to 2.5% range, it would be far better than some of the concerns that are going around right now on the inflation front.
Well, exactly. And if you look at the history of the performance of stocks, they can do fine with inflation up into the 3 to 3.5% level. And companies have pricing power, and they tend to do pretty well in that environment. PEs don't get hurt too bad. So in our positioning, we are in a 60-40 portfolio, 68% risk assets and just 32% in bonds, because we do want to be positioned for growth, but we want to understand the inflation sensitivity of what we own. And that's why we would favor natural resources, for example, over TIPS.
Shepard Smith here. Thanks for watching CNBC on YouTube.